Welcome to the deep dive. Today we're asking, how does a company like Concrete Pumping Holdings, that's ticker BBCP, manage to beat earnings when the construction market seems to be hitting the brakes?
Yeah, it's a great question.
We're going deep into their Q3 2025 results to see what's really going on under the hood, what strategies are working.
Absolutely. And looking at Concrete Pumping Holdings, well, it gives you a fantastic window into a really critical part of construction. It lets us see how companies are navigating these tricky economic times, high interest rates and all that, but also setting themselves up for future growth. Understanding that playbook is key right now.
Okay, let's unpack the numbers first. Headline figures. Concrete Pumping Holdings had, a pretty solid Q3. They reported GAAP earnings per share, that's the standard accounting profit, came in at 0.47 some cents. Better than the $1.06 expected.
Right, a decent beat there.
And revenue was $103.7 million, also beating the $99.76 million forecast. Now, revenue was down 5.4% compared to last year.
Which is important context.
But the market, it seemed to like the overall picture. The stock ticked up in after-hours trading, volume increased, suggests investors saw something positive despite that year-on-year dip.
And that's what's really fascinating, isn't it? That market reaction. Despite revenue falling year over year, beating on both profit and revenue, and reaffirming their guidance for the year, that clearly hit the right notes for investors.
Yeah.
It signals confidence, I think, in management's execution. But we need to add some nuance too. Gross margin did slip down 160 basis points, so 1.6 percentage points, to 39%.
Okay.
And adjusted EBITDA, sort of a core profitability measure, was $26.8 million. Its margin dropped 300 basis points, 3%, down to 25.8%. So not all rosy on the margin front.
So the market cheers the beat, but maybe overlooks those margin declines a bit. How are they managing costs to offset that? Is that the story?
That's definitely a big part of it and takes us right into their operations. So beyond the headlines, you look at the segments. U.S. pumping revenue, $69.3 million.
Right.
Down from last year. And management pointed figures directly at, construction softness, particularly those light commercial projects that are really sensitive to interest rates.
Makes sense.
Plus, they even estimated a $2 million hit just from unusually heavy rain in the central and southeast U.S.
Wow. Okay. So you've got macro pressure and then just plain bad weather hitting them.
Exactly. A double whammy.
So the question then becomes, how do they stay resilient? How do you manage margins when you've got stuff like weather you just can't predict?
Well, management kept highlighting their focus. It's disciplined cost management, first off. Then fleet optimization, getting the right pumps to the right jobs efficiently. And strategic pricing.
Okay.
It's not just cutting costs across the board. It's being smart about where and how. Making sure the pricing reflects the value, even if volumes are a bit lower. It shows, I think, pretty good operational control.
And this is where the diversification seems to pay off, right? Because not everything was down.
Precisely. Their EcoPan segment, that's the concrete waste management business, that was actually a bright spot. Revenue up 4% to $19.3 million.
So what drove that?
Strong pickup volumes for the pans. And they managed to hold on to pricing gains. It's not just diversification for its own sake. EcoPan has this higher margin, more recurring revenue feel to it, which really helps smooth things out when the core pumping business is facing those cyclical headwinds. It's a ballast.
A ballast, good way to put it. So connecting that bigger picture then, EcoPan provides stability. What about overseas? The UK?
Right, UK operations. Revenue there was $15.1 million. They saw softer volumes too. Again, high interest rates, economic uncertainty hitting commercial construction.
Same story, a different country.
Pretty much. Although they got a bit of help from foreign exchange rates, about a 500 basis point tailwind. Basically, favorable currency moves boosted the numbers in dollar terms.
Okay.
But interestingly, infrastructure projects, like the big HS2 high-speed rail project over there, that held up well. And that mirrors what we see in the U.S. with infrastructure demand staying robust, thanks to that IIJA funding the big infrastructure bill. Yeah. So infrastructure spending globally, that's a consistent positive theme for them.
We've talked operations segments, but how solid is their financial footing to, ride out these headwinds and maybe even grab some opportunities? What's the balance sheet look like?
Good question. They finished the quarter with pretty solid liquidity, around $358 million available.
That sounds decent.
Yeah, it provides flexibility. Net debt was about $384 million. That puts their leverage ratio at roughly 3.8 times their trailing 12-month adjusted EBITDA.
Okay, 3.8 times leverage. Is that comfortable territory given the market slowdown and that recovery timeline being pushed out? Does it leave room for deals like bolt-on M&A they sometimes talk about?
It's a fair point.
Yeah.
Look, 3.8 times isn't worryingly high for this industry, and that big liquidity cushion helps a lot. Their actions also suggest confidence.
How so?
Well, their capital allocation. They bought back shares, about 593,000 shares for $3.8 million in Q3. Average price, $6.40. And since 2022, they've repurchased over 4.6 million shares for around $30 million total. And they still have $20 million left on their buyback authorization through late 2026.
So they're actively returning capital.
Right. And don't forget, back in February 2025, they paid out a big $1 special cash dividend. They funded that alongside some new debt, $425 million in second-hand notes due 2032. So yeah, returning cash to shareholders, even now, shows they feel pretty good about their financial position and cash flow.
Okay, so with those challenges, but also those strengths in mind, what are they telling us about the future, the outlook?
Well, the big news here is they reaffirmed their full-year guidance for fiscal 2025.
Right, despite the Q3 headwinds.
Exactly. They still expect revenue between $380 and $390 million.
Yeah.
Adjusted EBITDA between $95 and $100 million, and free cash flow around $45 million.
Reaffirming guidance when things are uncertain, that usually signals confidence, doesn't it?
It definitely does. It tells you management feels they have a good grip on the business, on their costs. They said they expect Q4 to look pretty similar to Q3, maybe slightly better with an extra day. They sound confident about margins and volumes for the upcoming quarter.
Okay, but they did push out the timeline for the wider market recovery, right?
Yes, that's the other side of the coin. They're now saying a sustained recovery won't really kick in until late fiscal year 2026 or early fiscal year 2027.
So another year, year and a half, maybe?
Seems like it. And they expect pricing pressure to stick around for maybe another 6 months before it starts to ease up. On the plus side, they did mention bidding activity has picked up slightly. A little green shoot, perhaps.
And any difference between types of construction?
Yeah, the noted light commercial is still tough because of rates, but residential, they see that as largely resilient.
Like that.
Basically, the structural housing shortage. There just aren't enough homes, which creates a fundamental demand floor, even with higher mortgage rates. And they're also being proactive, expanding geographically, trying to win work on those massive new projects, semiconductor plants, data centers, big manufacturing facilities, often in new regions for them.
Smart move, follow the money.
Essentially. And one last macro point, tariffs. They don't expect a direct near-term hit, but all the uncertainty around trade and the economy, that is causing some customers to hesitate, delay decisions. That's a common theme everywhere right now.
Okay, so pulling all these threads together, how should someone listening think about concrete pumping holdings from, say, an investor's point of view? How does it stack up?
Well, if you look at recent performance against benchmarks, BBCP stock returns, like plus 0.3% over 1 month, plus 7.4% over 3 months, they've actually lagged behind broader industry ETFs like PAVE, the infrastructure one, or XLI, the industrials ETF.
So underperforming recently.
In the very short term, yes. But their 1-year return plus 15.4%, that's more competitive. It suggests maybe longer-term resilience, even if the near-term sentiment is a bit cautious.
Okay, so what could change that near-term picture? What are the potential catalysts?
Well, the pattern really points to how sensitive the market is to those immediate economic signals right now. The company's longer-term story hinges on a few key things. Number one, interest rate cuts. If rates start coming down, that could really breathe life back into that light commercial sector.
Makes sense. Lower borrowing costs, more projects pencil out.
Exactly. Not just cost, but overall confidence, too. Then there's the infrastructure spending, both in the U.S. with the IIJA money and the U.K. with HS2. Seeing those big announced projects actually turn into shovels in the ground, that's a huge visible catalyst with a long runway.
And don't forget Ecopan, right? Continued growth there seems pretty baked in.
Absolutely. Steady organic growth from Ecopan is crucial. Plus, the potential for more bolt-on acquisitions using that strong liquidity they have.
And you mentioned residential being resilient. Any acceleration there would be a big plus, too.
Oh, definitely. Given that housing supply shortage, any sign that residential construction is really picking up steam again would be a significant tailwind for them.
So multiple potential drivers there.
Precisely. And one other thing management really emphasized was operating leverage. This is quite interesting for the longer view.
Okay, what do they mean by that?
They expect an outsized benefit from the investments they're making now in equipment, in people, once the construction market properly recovers.
So they're ready to scale up quickly.
That's the idea. It translates, they say, into bottom line expansion through improved fleet utilization and higher efficiency. Basically, when volumes come back, profitability could snap back even faster because they've already got the capacity and efficiency measures in place. That's a compelling potential upside.
All right, that leads us nicely into our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea based on everything we've just discussed.
Okay, let's give it a shot. So you've got the reaffirmed guidance, right? The positive market reaction to the beat. But also management clearly saying the big recovery is pushed out to late 26, maybe early 27.
Right.
So here's the thought. Maybe consider a long-dated call option strategy on concrete pumping holdings. We're talking expirations way out there, late 2026, early 2027.
Long-dated calls. Explain the thinking.
Okay, so a call option gives you the right, not the obligation, to buy the stock at a set price by a certain date. The play here is a bet that the market today isn't fully pricing in that operating leverage and margin expansion potential that management keeps talking about once volumes return.
So you're betting on that eventual recovery, but using options to potentially leverage the timing?
Exactly. The outrageous part is making a specific bet on that turning point 18, maybe 24 months down the line. It's tricky timing the market cycle that far out.
Okay, and the plausible part?
The plausible part comes from everything else we talked about. Their solid capital allocation, the buybacks, the strength and resilience of Ecopan, and just the sheer scale of those infrastructure tailwinds, the IIJA, HS2, that will eventually translate into serious revenue. The current pricing pressure, the slow commercial market, those could be seen as temporary issues offering a potentially better entry point now for that longer-term story.
Interesting angle. Betting on the leverage kicking in when the cycle turns.
That's the core idea. Again, not financial advice, just a thought-provoking trade concept.
Understood. And that wraps up our deep dive into concrete pumping holdings and their Q3 2025 earnings. What we've seen is a company showing definite resilience, beating estimates, holding guidance steady, even with clear headwinds.
Yeah.
The Ecopan strength is undeniable, and those long-term drivers from infrastructure and maybe eventually housing, they provide a pretty solid foundation.
Indeed. I think the key takeaway for you listening is how a company's strategic choices, now how they manage costs, allocate capital, position their segments in a tough market, can really set the stage for significant gains when things eventually turn around.
Right.
The big question hanging out there is, will those catalysts we discussed, rate cuts, infrastructure projects really ramping up, actually line up with management's own recovery timeline into 2027? That's what we'll be watching. Thanks for joining us for this deep dive.
And just a reminder, everything we've discussed here is for informational purposes only. It is definitely not financial advice. Please do your own research and always consult with a qualified financial professional before making any investment decisions. We look forward to our next deep dive.